Right, what's up everybody? In this video, I'm going to go over these 2 trades that I took this week. In fact, I only took about 3 trades this week and I managed to secure a profit of about 6.5 grand. Now I'm going to walk you through how I came up with these 2 trades. Hopefully you'll be able to learn a couple of things and apply it to your own trading so that you too can make a 6.5 grand. Now I'm also going to talk about this Avax trade that I called in the private group yesterday and how this came out to be, like how I predicted the bottom pretty much perfectly, and how you can apply this as well to your own trading so that you too can predict bottoms. And without any further ado, let's just dive into the Avax one first because it's simple. So Avax, as you can see, I have not done any kind of changes to the chart. So you can see that I have predicted this initial move wrongly, but I did predict the bottom. I did get pretty much the picture perfect entry. As you can see here, I did not change anything from this picture that I called yesterday at 5 p.m. So at the time when I called this, the price was only about here. And so I was predicting price to return back to the 0.5 over here, which is what price tends to do, right? Price doesn't just go straight up or straight down forever. There tends to be a retrace back to the 0.5. And for those people who are wondering how I'm drawing these fibs, basically you just want to draw it at the swing point, the most extreme point. So that's going to be on the chart yesterday, it was going to be from this point here to this point here. Notice how these 2 points, you can just draw a swing from top to bottom, and that would be the swing. Notice how this and this wouldn't be the swing point, but within the context of the swing, you can draw another fib as well, but that is besides the point. So I drew the fib from this high to this low, and for your information, if you're wondering if you should be drawing your fibs from top to bottom or bottom to top, if you're looking for shorts, then you draw from top to bottom. If you're looking for longs, then you draw from bottom to top. It's basically as simple as that. And so what I was looking for was price to come back to the 0.5, right? To come back to equilibrium first before going down to the 618 of your external range. So notice how within these 2 movements here, you could have drawn 2 fibs. So within this external range, right, this is called an external range, I was looking for a retracement back to the 618 for a long to take out a previous level. But then when you're determining when you can secure an entry, you can use the internal range and draw a fib on the internal range, right? This is your internal range. This is your external range. So I drew a fib on the internal range to determine where my entry would be, where I could take a short down to this area, and then from here, take a long to take out external range liquidity, okay? This is one of the key lessons that I hope you guys can learn, which is to understand your external and internal ranges. A lot of people get too caught up and say, oh, you draw a fib from here to here or something like that, and then you look for a retrace. But then externally, right, you've already filled in the retracement. So there's not a very high chance where you will come back down here to retrace so deep, because the market makers have already filled their positions when they brought the price down back to the 618, which is the golden pocket. So by having an understanding of your external range and where you are in the bigger picture, it allows you to understand where the price is likely to go next. So seeing how the retracement has already been filled, I'm not looking for a deep retrace. In fact, I'm just going to take opportunity of this sort of, retail traders would like to call this a bull flag, but I just like to call it a range. So if the range lows get taken out, that's an opportunity for me to go long to target the range highs, right? External range liquidity, and even beyond that. So if you go onto the 4-hourly chart, you can see that this whole thing here, you could even say this whole thing here is a fair value gap. All I have to do is draw a fib from, let's use this fair value gap here. And let's say I want to take profit at the 0.5 of this 1 hourly fair value gap. But in this case, the reason why my profit target is set to there is because if you notice, this is where you have some kind of price action, right? That wick, even though it's just a wick, but price action starts to pick up there. So that's where I want to take my profit, ideally just slightly below, because you want to, the markets are a zero-sum game. Everyone is out to take your money. So if everyone's going to be taking profit here, I would much rather take my money a little bit earlier, right? So that I can secure my profits instead of fighting with everyone to get the quote-unquote perfect entry. Right, there's a saying that I always love to say, which is I would rather be consistent than be perfect. And I really hope that you can apply this to your trading too, because I'm sure you've been through this exact scenario before. You try to be perfect, you try to get the perfect entry, you try to get the largest trade, it stops short. And you're left there wondering hey, I could have secured this much profit or this much profit. But because I was trying to shoot for a home run, I didn't get anything. In fact, I might have lost money. All right. So it's very important as a trader to be consistent. Understand that this is a long-term game you're playing. Every single day that you are in these markets, your equity, right? Your account is just going to keep getting bigger and bigger and bigger. And eventually it's going to hit a tipping point. It's not about trying to get the home runs like $5,000, $10,000 in one trade. Like, sure, maybe you can do that like once or twice a month, but can you really call yourself a trader if you're only winning like one trade a month? If that makes sense. So be consistent, not perfect. So basically, this is a perfect application of external range, right? Understanding the external range is going to go for a retrace back to here, and then using the internal range to get an entry to, target the external range target. And then once you fill in, right, once you get this entry, my target for this long is going to be external range liquidity, right? Because think of it this way, when price has been doing this whole move down here, it has already been taken all the liquidity that is present in this area, right? This is your internal range liquidity. It's already been filled. So there's no reason for them to bring the price lower again before targeting external range. So basically what I'm trying to say here is internal is already done. Now you target external, right? So this is going to be TP number 1. That's going to be TP number 2. And if it goes higher, then I'm going to get into another entry. No problemo. So that is basically the Avax trade broken down to a science and how I managed to catch the bottom, like pretty much. And if you want to get access to more trades like these alongside my team who are absolutely killing it, then consider joining the private Discord group. The link will be in the description box below. But otherwise, let's move on to the second trade. Let's talk about MTL first, which was also called on the private Discord group. So MTL, if you can see the executions on the chart, I originally had my TP, I believe, over here. So I believe my original TP was either here or there. But I will show you the account history, and we can see that on the coin MTL, my original limit was at 620, which I cancelled. So let's talk about why I cancelled it and took my profit over here instead of, waiting for the price to hit here. Because you notice that I pretty much shorted the top of this and caught the exact bottom of this. Now, how did I know that it was going to retrace and start pumping again? Because if I waited for my original TP target to get hit, I would be pretty much almost back to break even at this point. And this goes back to what I said earlier about being consistent rather than being perfect. I'm happy securing a large chunk of the move as my profit rather than trying to be perfect and show off to everyone that, oh, I caught the top and I got the bottom. Now, that's not the point of trading. In trading, it is way more important to be profitable than be right. I know that sounds very obvious and duh, but it's true. And yet so many people don't understand this. Everyone's trying to be right. Nobody's showing that they can be profitable, if you know what I mean. So if you want to be profitable, it's much more important that you be consistent rather than be perfect, right? That's all there is to it. So let's talk about the entry first. And just to show you again, you can see my executions on the chart. I could go onto the chart and if you look at the arrows there, just look at the arrow as these are real executions. I actually took these. So just to prove to you that this is not fake. So if you go on to, this one as well, I called this trade, shorting MTL at the 2 white lines, right? I called this. So let's talk about why I took this entry in the first place. So earlier this week, I made a video called, Is This the Best Scalping Strategy? And in that video, I taught you how I use this tool called Scalper Scanner to identify coins that are very likely to move. And using Scalper Scanner was how I identified MTL as an opportunity where I could go short. If you haven't watched that video already, it is as filled with value as it is in this one, with a lot of actionable advice. And I show you exactly how to use Scalper Scanner so that you too can turn $25,000 into $45,000 in 3 days. Of course, I'm not promising that kind of result. At least it shows you what is possible. But watch that after this video. So basically, I first used Scalper Scanner to identify that this thing was moving. And whenever a coin moves this aggressively, you understand that this coin is being manipulated by the market makers and the whales. I like to say, a trader's best friend is volatility. It doesn't matter if it's going down or up. As long as there's volatility, you have an opportunity. That kind of rhymes now that I realize where there's volatility, there's opportunity. So basically, what I identified was, firstly, when coins like this, right, metal, MTL, I'm pretty sure you've never even heard of this coin before. And even if you have, it's everybody knows that it's a shitcoin and there's no real use case for this, especially in a bear market where only the toughest things can survive. And just to prove my point, you can see that this is basically, everything is in a downtrend, but this is definitely a shitcoin, right? And so with shitcoins, whenever you see shitcoins going straight up, you notice it tends to happen quite a bit, right? Over there, you go straight up, straight up, straight up. But every single time you have went straight up, you have tended to come back straight down. There, you've got right there, there. Basically, you retrace all of the gains that you make when you go straight up. So I understand that this is just manipulation and price is likely going to move really fast while it takes out the liquidity. Now, what is liquidity? Basically, you look at all of these previous highs, right? Notice how all of these highs are in a relatively equal position. And then you have this high over here. And then you have a fair value gap over here on the 4-hourly chart, which was what I was using. So basically I understood that within this entire box here, you could just look for a short because it's going for, like, it swept the liquidity already over here and over here. Now let's talk about liquidity for a second. Liquidity basically just means, like, I want you to imagine that the market is a Ferrari. And in order for the markets to go up or down, you need fuel, right? Makes sense. As a car, you need fuel to get anywhere. So this fuel that the markets use is liquidity. And liquidity is present at previous lows. Notice how after you take out these lows here, you started to show signs of a retracement. Over here, you have a low, right? I'm using the candle bodies here because that's where most of the market maker volume, right? The institutional volume, the smart money volume is concentrated in the bodies, not the wicks. That's why I like to use the bodies. So notice how the moment you swept the bodies, boom, right? You could have caught the bottom right then and there if you wanted to, right? Notice how after you took out a liquidity, you have no reason to go lower anymore because the only liquidity left is here. Whereas up there, you have a ton of equal highs where every time you see relatively equal highs or relatively equal lows, that is even more of a bigger signal that there is a lot of liquidity there, right? Again, after you take out this low, you reverse. After you take out this high, you reverse down, right? So notice how every time the market goes up, it's going for an objective, right? There's liquidity over there. You take out the liquidity, you go for the liquidity below. You take out this liquidity, you go for the liquidity above, right? It's as simple as that. So what I noticed on Scopa Scanner is that liquidity was being taken out and then you just coming into the fair value gap. So it was pretty easy to short, basically. Like the idea is just, if you see a shitcoin pumping and you see it take out multiple levels of like important areas of liquidity, just short it because there is only so much fuel to get this coin from basically 0.6 up to 0.9, which is a 50% pump in about 12 hours. This is not sustainable, right? Anything that goes straight up always comes straight down. Remember this. The only thing that you have to caution yourself against when you're doing something like this is that you need to have really big balls because price is going to be moving very, very quickly while you're shorting and you have to be able to sit through that, right? You're likely going to be in a drawdown. You're very likely not going to catch the exact top. And so you just have to, like, if price goes beyond your entry and puts you in the red, you just need to have conviction and understand that anything that goes straight down, especially a shitcoin that goes straight up, is going to come straight down. So that's basically what I did, just do that. And let's talk about the TP. Now, remember earlier I said, after liquidity has been taken, right? All the liquidity has been taken. Where is the next point of liquidity? It's over here, right? Or you could even say it's over here at this order block. But notice how price did not come back to the order block. And here's why I took my profit. And this goes back again to being consistent rather than perfect. As a trader, one of the most underrated skills that people don't talk about that you need as a trader that will serve you really well as a trader is the ability to read and react and adapt quickly. So what I noticed here was that during this entire time, right, price was making lower lows and lower highs. Notice this, right? On 1 hour, it was making lower lows and lower highs until this point where it made potentially a higher high, potentially. But I wasn't about, like at this point here, I was like 4 grand under profit and I wasn't about to risk an extra 2 grand. Like I wasn't going to go for an extra 2 grand and risk losing 4 grand, right? Basically, I would be happy. That is an amount that I'd be happy securing right then and there rather than trying to go for the perfect amount. So what I did was I saw that the market structure was changing for the first time in this entire downtrend. And so during the next retrace back down, so as it was going up, I believe, there was a slight bit of a retrace. It's not very obvious on the 1 hourly chart. I think it would be more obvious on the 15. Yeah, so after you went up here and you came back down a bit, that's when I took my profit. And I'm like, cool, it might not be the bottom. Sure, it can continue to go lower. And if it does, cool. But this is an amount that I was happy with. And I'm very happy just being consistent rather than leaving all these profits on the table and then let it disappear, right? Like what it did here. So that's a lesson. And the second thing that I saw was this fair value gap over here on the 1 hourly chart. Notice how like there is zero price action. Let me just remove everything here. Notice how from this point onwards to this point, there is zero price action, right? This is called a liquidity void, or otherwise known as a fair value gap. So what I noticed was that this fair value gap has just been filled. And if I, like at the time, I did not draw a fib, but if I drew a fib, I'm pretty sure, well, yeah, you're way below the discount. So basically the goal of like when you short anything, you're shorting it at a premium, right? If you imagine the market as this is the low, this is the middle, this is the high, then in the middle here is where the prices are offered at fair value. Because notice how price stays like around the middle point for quite a long time. This is known as fair value. Basically, if I were to sell you an iPhone for $1,000, that would be fair value, right? If I sold you an iPhone for $2,000, that's a premium. That's when prices are over here. And if I sold you an iPhone for $500, prices would be over here. The goal in any market when you're shorting is simply to sell something at a premium and then buying it back at a discount. So this is already in a deep discount. So I'm perfectly fine. After it takes out after it fills in the fair value gap, I'm like, okay, the probability of this going lower rather than higher is lower. Like it is more likely after it fills in this fair value gap to reverse than to keep going down to take out this liquidity. Now I could be wrong, but it doesn't matter. Another very important skill that you need to have as a trader is probabilistic thinking. So it's not about having a certain bias, like, oh, price must come here or price must come here. Whoever has done that before, you know how it ends up. You usually lose a ton of money. The best way to think about this is to think in probabilities. At any given moment, what is the higher probability outcome? Is it more likely to go up or is it more likely to go down? And as a trader, as long as you can keep taking the higher probability outcomes over the lower probability outcomes consistently over time, you're going to be profitable. You're going to make a lot of money. And as long as you can stay disciplined enough to keep doing that, that is easy money, right? That's how you make money as a trader. It's not about always being right. It's just about taking the higher probability move. It goes back again. It's much more important to be consistent rather than be perfect. Okay? If you can get that mindset down, you're going to be successful. So that's the second entry, right? Just to sum it up, right? Just to sum up this trade, if you see a shitcoin going up, like straight up, and you see it take out multiple key levels at once, you can short that, right? It's a pretty easy money. You just need to have the conviction and the balls to hold on to the trade enough, even though it might put you underwater. Like I think my entry was at around 774 or something, right? It was around here. And price actually came all the way up to there, but I was fine, right? It's fine because you understand direction. A lot of the time people struggle with, like, they get the direction, but they don't get the entry. And so what I say to that is just understand that when a coin is going straight up or straight down, it's a period of very high volatility. And every time the market goes through a period of high volatility, it tends to go through a period of low volatility, right? That's why you see like flags or distribution patterns or heads and shoulders, inverse head and shoulders, three drives patterns, whatever. That's consolidation. High volatility into low volatility. So if you understand that, then, you know, during high volatility, just don't set a stop loss. I know that sounds very counterintuitive. Of course, only risk an amount that you're willing to lose. But if you get your risk management down and you just run a manual stop, right? Only after prices confirm structure, then I move my stop loss to here to protect myself against any further downside. Then yeah, that's all you need, really. It's just understanding direction and having the conviction to go along with the trade. That's how you make money as a trader. Now, if you watch until this point so far, it's obvious that you are not like everybody else, because everybody else would have clicked off the video at some point. The fact that you're here proves to me that you're someone who's really serious about learning. And let me just tell you that you can watch as many of these videos as you want on YouTube for free, but chances are you've already done this before and you're finding that it's not really helping you too much. Chances are all you needed this whole time was just somebody to coach you and guide you into the right direction and make sure you're skipping all the obstacles that you face as a beginner trader. And I'm happy to announce that next month, I'm going to be doing a second intake of the mastermind that I just launched, which everybody, like, it's only been 4 weeks in and somebody already got funded as a trader for $50,000. I'm going to be doing a second intake of only 10 people in January. If this sounds like something you would be interested in, where it's going to be very focused on coaching and getting the results in like 1/10 of the time, then I want you to shoot me a DM on Twitter saying mastermind. That's all you need to say, and I'll get back to you. But anyways, let's move on to the third trade and the final trade. And this one's going to go over pretty quickly. So as you can see, I have taken my profit. I shorted Optimism coin over there and I took my profit over there. Now again, this was another one of those situations where I wanted to be consistent rather than be perfect. I had a feeling that it was going to go to the 618, but I would rather just secure my profit at the 0.5 because I wouldn't want to risk all these profits just evaporating in the thin air, as you can see here, where, price really did evaporate most of the profit if I would have held on. Let's talk about this coin. Now, again, this coin, as you can see here, has been called in the private Discord group. So if you want to join the private Discord group, link will be in the description box below. Basically, I called it like around here. I said I wanted to short this because it was at the range high and I wanted to short it back to 0.92, which is at the 0.5, right? Check it out, 0.92. That was perfect. Now, I might not have caught the exact top. I might not have caught the exact bottom, but in my book, in my eyes, when I was taking this trade, this was a perfect trade. A lot of the times people get hung up over, oh, I secured my profit too early and, price eventually went even further. Here's what I have to say to that. If you had a plan before going into the trade, for example, you short here and you wanted to TP here. And if the trade goes according to plan, basically it hits your TP, you didn't get stopped out, in your eyes, that should be a perfect trade. Because when you set out, that was your plan and your plan played out perfectly, like to the letter. So in that sense, it is a perfect trade and you should be happy. And that's how you become consistent and profitable as a trader. Just have a plan every time you go into a trade. As long as the plan plays out, that is a perfect trade. You don't have to think about it too much. Like in the markets, there is no such thing as a perfect decision. Like sure, you make a perfect decision once or twice, right? Maybe you get it. But then what about all the other times where you're shooting for the perfect decision and it doesn't happen? You're screwed. You just lost money, right? So again, it just goes back to consistency over perfection. So let me walk you through what I was thinking about when I took the trade. Like since you can see this big fib here, I'm going to talk about this first. Basically, I understood that this is your external range, right? Notice this is your external range. This is your internal range. And then within this internal range, you have like a baby range, right? Let's call it a baby range. So what I was looking for is that I did not want to take too big of a short here, right? Basically, the chances of price, the probability of price getting rejected here and going all the way back to the bottom or even lower, it's fairly unlikely because within the context of your external range, notice how you are below the 0.5. In fact, you're quite a bit below the 0.5. So this tells you that the price is currently trading in a deep discount. Remember what I talked about earlier about the iPhone? Right now, the iPhone is trading at about $500. And when the markets spend too much time in a premium or too much time in a discount, which currently is, the algorithms, right? The market maker algorithms that deliver price to you as a retail trader will want to bring the price back to a state of balance. And nothing shouts balance more than a 0.5, right? It is literally the middle, the mid-range, balance, equilibrium. So that is what I had in mind. Basically, if I shorted this, I did not want to take my profit too late, right? I understood that within the bigger picture, this would be a counter trade trend because in the bigger picture, I should be looking for buys, not shorts. So if I did take a short, I want to be able to take my profit pretty quickly and then, catch a wave going upwards, right? It's not about shorting all the way down. And again, this is one of the things you need to understand as a trader, which is your bigger picture. Where are you in the bigger picture? If you don't understand your bigger picture, maybe you would have shorted this and said that, oh, range high, range low, you're going to go back all the way down to here, right? But when you understand the bigger picture, then you can say, okay, this is a counter trade trend. I'm going to take my profit pretty quickly and I'm going to, take a long. Now that that's out of the way, right? External range, internal range, and then like a baby range, right? So let's talk about this baby range. What I saw. Again, the way that I came up with Optimism was through Scalper Scanner. And if you want a full breakdown on how I use Scalper Scanner, step by step, I made a video already where I turned 25K into 45K in basically 3 days. So almost double my account in 3 days. Right here, you see that you have a range high. The only reason that makes this a range high is because you have 1, 2, right? You have 2 taps. So that's the range high. This would be your range low. Notice how when your range low got taken out, you go target the range high. So I understood that every time the range high is taken out or every time the range low is taken out, I want you to recall what I told you guys earlier about liquidity. Liquidity has already been taken here. There's no reason for the market to just go straight up. Again, nothing goes straight up or straight down forever. This has already went straight up. So now that it's taken out all the liquidity, there is going to be higher resistance, right? It's going to be harder for the market makers to push the price above and get it all the way to 0.5 without first sweeping up some internal range liquidity. Again, if you imagine the market as a car, you need fuel in order to go anywhere. If you want to go up, you need to go down first to take what? To take liquidity. The liquidity came in the form of this fair value gap, which I took my profit at, right? 9.2, 0.92, check it out, right? That's the enter, like that's the beginning of the fair value gap, right? I already saw this beforehand. Basically, take out a range high, shorted that. Now, this is one of the good examples of how you should never FOMO. And you should never look to get into an entry too quickly. So if you take a look at this quote here, I actually mentioned it on Discord, right? Optimism coin. I entered a bit early, but this is a good example of how distribution takes time to play out. You never have to enter right away, but I did, and it worked out. But it doesn't always work out, right? Sometimes you're going to go much higher. So a good rule of thumb is, check it out. This is sort of like a distribution pattern, right? It's what retail traders would classically known as a heads and shoulders pattern. And this is the neckline. You break below the neckline, you come back, retest the neckline, and then you drop down. So basically, you never have to FOMO. Like once price gets taken out, just wait. Like just wait a bit. I made a mistake and it's cool. This is another one of those examples where I just ran a manual stop until I got confirmation that like a high was formed. So I think I entered right at the sweep of this entry. As you can see, price actually went above my entry 1, 2, 3, 4, 5, 6, 7, 8, like about 8 times. But basically, from the time that I entered, for the next 1 day and 8 hours, price was actually trading above my entry. And I was perfectly cool with that. I remember seeing my position down like $500 or $1,000, but I was, again, perfectly cool with it. It comes back to having conviction and understanding that price action takes time to play out. It's not as instant as a lot of traders think it will happen, right? We expect that we go into a trade and it needs to play out immediately, right? Go straight up, go straight down. When rarely that is the case. Now, sometimes that is the case, but not always. Like basically the moral of the story here is that if you do enter and you see that price is taking on some kind of a distribution pattern, have conviction and wait it out, because you know that this is a bearish pattern by nature and all it takes is some time for it to play out. Imagine if you just got too scared or you thought it was too painful and you just got out break even, then you would have missed this entire thing like 1 day later. Is that worth it? Not really. So then one question you might have throughout this whole video is, how do I build conviction then? Well, that comes from a lot of practice, basically. And the way that you can practice is just turning on this replay mode here, right? What my guidelines for backtesting is very simple. You go onto the monthly chart first, right? Start off on the monthly chart. Now zoom out, or just go to the bottom here. And then you turn on replay mode. You just go to a random month. Right, let's say I want to do 1 October. And because I'm starting on the monthly chart, I have no idea what price is going to do next. So I could just say, oh, in a monthly chart, your range is between here and here. So if either one of these levels gets taken out, I will look for an entry. Okay, now that I'm on the weekly chart, this is a little bit more refined. I can see that there is a fair value gap over here. So if price does come back to this fair value gap, then that's where I will look to go long. Until that happens, I'm going to look to go short and then just go into the daily chart. Like, okay, let's see if my theory on the higher timeframes are supported. And if I just take a look at the chart here, okay, maybe there's like a bit of liquidity over here. There's a bit of liquidity over here that you're targeting on the daily chart. So that supports my theory. The fact that you have filled in this bullish order block here and you still haven't bounced leads me to believe that there might be a potential liquidity sweep before going higher. So I'm going to look for a short and, let's just see how it plays out. And right there, you get your liquidity sweep. So that is how you practice that's how you practice basically. And of course, you don't have to start as high as the weekly chart or the monthly chart or the daily chart even. You could do 4 hourly, you could do 1 hourly, you could do 15 minute, right? My guideline, my recommendation would be not to go below the 15 or even the 5, because when you go below the 5 minute, I think most charts, especially if you're doing a shitcoin or a coin that isn't very well known, there is only data that goes back about 3 to 6 months. Cannot be sure. So if you want to be safe, just stick to the 15-minute chart and above. And this is how you practice, right? Just trade as though you are trading in real life. Maybe you see that's your range low right there. That's your range high. So understand that if you take out a range low, I'm going to, do a trade going for the range high, right? So that's the range low taken out. Now I'm going to look for a sign that the market makers would want to bring the price higher. I'm going to wait for that first before I do anything. So maybe that would be like sufficient, hypothetically speaking, maybe that is sufficient enough proof that you are going to go up. Of course, it doesn't, but that's beside the point here. So just do that. That's how you practice. Okay, so back to back to real life. So let's just wrap up a couple of final things about Optimism coin. Basically, now that this internal move has been filled, I'm expecting the next move to bring us up to, equilibrium of the external range. And that's all there is to it, basically. Like, if you watch until this point, there is a lot of wisdom, like a lot of trading wisdom that you have just gained that people usually would take months or years to learn. And some traders go their entire career without ever hearing of the advice that I just gave you. So if you found this video valuable so far, you're going to find the mastermind 100 times more valuable than what you're getting in these videos. But if you're not interested in a mastermind, feel free to drop a like on this video if this has been helpful. And if you want more content like this, where we do deep dives into trades, just let me know in the comment section below and I'll make sure to do more videos like this. Until then, bye-bye, trade safe.